Hi guys, Will here from WB Trading. Thanks again for joining me here on the new YouTube channel today. So this is the first video of a new series that I'm doing here on the channel, Trading Terminology. So what I'm going to be doing is covering slightly more basic aspects of trading. So if you're a beginner, this video is very much for you. And of course, if you already know what R means, you probably won't take too much value from this video. But if you are a new trader and you have no idea what R means, then you're going to understand the terminology by the end of this video, so stay tuned. Now firstly, before we go any further, let's say you've just started trading a new strategy. Let's say the win rate is below 50%. Now these strategies can be quite challenging to trade, but if you've had, let's say, 5 losses in a row, 10 losses in a row, and you're panicking, then I think it's probably fair to assume that you might not know how to correctly understand win rates, what R means. You might also struggle to understand risk. And the reason I say that is because many traders out there have win rates as low as 25%. And you can profit using these strategies, and that's the reason that I'm putting this video together today. So if that has happened to you, or maybe it's even happening right now, maybe you've just had 10 losing trades in a row, this video is going to help you deal with that. So let's get into it. The term R stands for and represents risk. So R is a calculation that's used to manage risk and help us grow our trading accounts safely, and basically it acts as a measure. And we'll cover this in more detail in just a second. So instead of placing trades with no structure or plan, entering and exiting for varying and unstructured amounts of profit and or loss, putting huge amounts of your trading capital at risk, etc., which, as we all know, is a very dangerous game to play that rarely ends well and certainly isn't sustainable. A successful trader uses a measure, this being R, to manage risk and gain consistency in their position sizing. So, let's start with the obvious. We have to have a proven strategy and thus a positive expectancy, of course. Our expectancy or our win rate will dictate the R multiple that we should be aiming for. So for example, if we know that we have a win rate of, let's say, 75% with a 1R target in place, a lot like my pound dollar strategy does, then we know that over a large enough sample size, i.e. across enough trades to allow our positive expectancy to play out, using a 1R target, we have an edge over the market and we will see our accounts grow. But what if we have a win rate of 45%? So we lose slightly more than we win. Well, there's no need to worry. As ever, all we need to do is make sure that our winning trades are then bigger than our losing trades. So back to using R as our measure, if we lose minus 1R when we're wrong, but we win 2R when we're right, across a large enough sample size of trades, we have an edge over the market and we will see our accounts grow. So before we move forward, I have to emphasize what I've just said about a large enough sample size. Okay, so 5 trades, 10 trades, even 15 trades isn't always enough data to see an edge play out. So, in a worst case scenario, even with the win rate as high as 75%, we have to remember the markets are fundamentally random. So your first 10 trades could all be losing trades. The subsequent 10 trades could all be winning trades. At that lower level, the market is random. You can never predict what your next 10 trades, what your next 20 trades, what your next 30 trades are going to look like. But over a large enough number of trades, if you have an edge on the market, it will play out. And it will result in accounts growth. So let's simplify what I've just said and look at an example. So we have a £1,000 trading account, a basic understanding of risk, and we know not to risk any more than 1% of our account on any trade. So 1% of 1,000 is £10. So our risk, or our R, on each trade is £10. So let's say we're trading a strategy with a 45% win rate or thereabouts. So across 100 trades, we expect roughly 45 winning trades and roughly 55 losing trades. Again, this is never going to be exact, but we expect thereabouts. So when we lose £10 or 1R. and when we win £20 or 2R. So 45 winning trades at 2R each gives us 90R or £900. 55 losses at minus 1R is obviously minus 55R or minus £550. So we take the 550 we've lost, add in the 900 we've won, and we're left with a net profit of £350. Now, the point is, even with a low win rate strategy where we actually lose more often than we win, we can still profit, but only across a large enough amount of trades. Now, again, across only a few trades, 5, 10, 15 trades, the outcome is random. The market itself is random. If you're presented with a, let's say, 75% win rate strategy, you could start trading at the start of a 10 trade losing run. That can and probably will happen. You just have to allow your edge to play out. And that's the point of this video. You have to manage risk for the bad times. So this has been a simplified example. This is a beginner's video, but overall, you should now have a better understanding of how to manage risk in relation to your strategy's win rate and be able to use R as a measure going forward. Now, if you have any questions, as usual, I'm here to help. You can tweet me over at Twitter. I'm at WBTrading_, or feel free to drop a comment below here on YouTube and I'll come straight back to you and get that answered for you. Alright, thanks again guys. I hope you found that useful and I'll be back soon.